Welcome to the deep dive. I want you to picture a world right now that is just defined by these extreme, almost dizzying contrasts.
Yeah, it's a lot to take in.
It really is. Like if you just glance at the ticker tapes today, you're looking at global markets bleeding out, trillions of dollars in value.
Out of views.
And we have this brand new, rapidly escalating war breaking out in the Middle East that honestly threatens to choke off the entire world's energy supply.
Right.
And yet, if you force yourself to just look beneath that surface layer of absolute geopolitical chaos, there are these monumental, historic shifts happening.
Yeah, structural realignment.
Exactly. Realignments in global manufacturing, massive capital deployments in artificial intelligence, forced consolidations in streaming, and even the rapid formalization of emerging market real estate.
Which is creating unprecedented opportunities, but only for those who know exactly where the smart money is moving while the rest of the world is just panicking.
Right.
It is a phenomenal, albeit terrifying time to be an investor or a business leader. The sheer velocity of capital being reallocated right now today, it's staggering. But capitalizing on it requires a very specific discipline.
You have to separate the signal from the noise.
Exactly. You have to be able to separate the structural long-term signal from the immediate, deafening geopolitical noise.
And that is exactly our mission for you on this deep dive. We are entirely focused on digesting a massive, dense stack of business, financial, and geopolitical news from March 4th and 5th, 2026.
We've got a lot of ground to cover.
We do. We're pulling the raw data and reporting directly from the latest editions of Business Standard and the Economic Times. But we're also integrating something incredibly rare today.
Yeah, this is the really fascinating part.
It is. It's a highly detailed geopolitical market strategy document currently circulating among institutional investors and sovereign wealth funds. It's known colloquially as the Trump Conflict Playbook.
Yeah, and it's less of a news summary and more of a behavioral masterclass.
Right.
It maps out the exact mechanical relationship between military posturing and market pricing.
It really does. Now, here's our promise to you. We're going to cut straight through the noise. We are completely bypassing the emotional panic. Our singular goal is to extract exactly what you need to know to navigate this intense volatility. But before we get started, I need to set a very clear, explicit boundary here.
They're very important.
The sources we're diving into today contain highly politically charged content. They deal directly with the current U.S. administration, volatile global conflicts, military strikes, all of it.
Yeah, it's heavy stuff.
Please know that in this deep dive, we are completely 100% impartial. We are taking absolutely no sides, political, moral, or otherwise.
None.
We are not endorsing the viewpoints or the foreign policies described in the source material. We're simply acting as your analytical guides, breaking down the tactical frameworks exactly as they are presented in the documents.
That is a crucial baseline to establish. Our job is analysis, not advocacy. If a specific policy causes a supply chain bottleneck, we analyze the bottleneck.
Exactly. We don't judge the policy.
Right. We are looking strictly at the mechanics of how global events translate into asset pricing.
So with that framework in place, let's just jump right into the deep end. The macro geopolitical shockwave.
Let's do it.
The catalyst for everything we're seeing in the markets right now, all the red across the screens, is the escalating conflict involving the U.S., Israel, and Iran.
Yeah, it's intense.
The specific trigger point detailed in our sources is severe. The U.S. recently sank an Iranian warship off the coast of Sri Lanka.
87 dead.
87 deaths. And this maritime escalation was preceded by major coordinated airstrikes on Iranian targets on February 28th.
It's a significant, undeniable military escalation. And the initial market reaction has been correspondingly violent.
Brutal.
But what is truly fascinating here, and what the institutional sources are focusing on, is how predictably this entire scenario is playing out.
It's following a script.
Exactly. A recognizable tactical framework. That brings us to the Trump Conflict Playbook.
Okay, let's unpack this. Because reading through this playbook is like looking at the matrix of international relations.
It really is.
It claims that whether we're talking about the massive tariff dispute between the EU and Greenland last year, or the capture of Venezuela's Maduro, or this current war with Iran, there is a distinct 10-step pattern.
A formula.
Yeah, a mathematical approach to exerting maximum pressure.
Exactly. It operates on the premise that markets and international relations aren't random. They follow a game theory-driven algorithm. The strategists argue that the administration uses market volatility as an actual weapon of statecraft.
So let's break down these 10 steps.
Yeah.
Because understanding them is the absolute key for you to understand why your portfolio looks the way it does today.
Steps 1 and 2 revolve entirely around verbal pressure and strategic posturing.
Right, because a conflict of this scale doesn't just start with a missile strike out of nowhere. The playbook notes that this Iran situation actually started months ago. The sources highlight how the administration began with highly public tweets about a massive armada heading to the Middle East while urging the target to make a deal. But let me challenge that for a second.
Roll for it.
Is that actually a strategy, or is it just political bluster that the market has learned to tune out?
Oh, it's absolutely a strategy. And tuning it out is exactly what catches retail investors off guard.
Yeah.
This is the cable setting phase.
Okay.
It's about building credibility and forcing the adversary to expend resources without the U.S. having to fully engage militarily. The playbook draws direct, undeniable parallels to November 2025.
Oh, the Venezuela airspace thing?
Exactly.
Yeah.
The U.S. completely closed the airspace around Venezuela a full month before Maduro was actually captured. It was a massive logistical flex.
I mean, the Greenland dispute, too.
Right. Extreme verbal threats toward Denmark preceded actual sweeping tariffs on the broader EU. It's verbal pressure combined with physical, undeniable repositioning.
Designed to force a capitulation before a shot is fired. But, obviously, in the case of Iran, the table setting didn't result in a deal. Which leads us to step 3, the Friday night strike.
The timing here is absolutely everything.
Yeah, the airstrikes on Iran happened on February 28th, which was a Friday. The playbook points out that major market-moving actions almost always happen late on a Friday.
Like the June 2025 strikes on Iranian nuclear sites.
Or the Caribbean drug operations in September. Now, the obvious assumption is that they want to bury the news going into the weekend.
But the playbook argues it's much more mechanical than that. It has nothing to do with the news cycle and everything to do with market plumbing.
Market plumbing, explain that.
Think about modern trading. When a geopolitical shock hits during active Tuesday afternoon trading hours, liquidity instantly vanishes.
Because the algorithms freak out.
Exactly. The high-frequency trading algorithms just turn off. They widen their spreads to infinity because their risk parameters are breached. Price discovery completely breaks down.
And you get a flash crash.
Right. By executing these kinetic moves on a Friday night after equity markets close and before Sunday night futures open, you artificially create a massive buffer.
But wait, does a 48-hour buffer actually prevent the crash? Or does it just delay the inevitable?
It shifts the reaction.
Because if I'm a hedge fund manager reading the news on Saturday morning, I'm still hitting the sell button in the absolute second futures open on Sunday night.
True. But it shifts the reaction from an algorithmic panic to a human-calculated repricing. Over that 48-hour window, institutional investors have time to actually run their models. They calculate the actual supply chain exposure. They aren't reacting in 4 milliseconds based on a headline-scraping bot.
Right, they're reacting after 2 days of analysis.
Exactly. Yes, futures will gap down, but it prevents the mindless, uncontrolled contagion that threatens systemic banking stability.
That distinction between algorithmic panic and human repricing is crucial. Which brings us to steps 4 and 5.
Yeah.
The risk premium expansion and the forever war tease.
This is where it gets psychological.
Right. Sunday night rolls around, futures open, things drop. But then initially, the market kind of just shrugs it off. On Monday, March 2nd, the first trading day after the Friday strikes, oil prices actually reversed 70% of their initial weekend gains. The S&P 500 turned green. The market essentially bought the dip. Why are they buying into a war zone?
It's the psychological conditioning of the market. Over the past year, investors have been trained by steps 1 and 2. Because they know the administration views these conflicts as leverage to make a deal, they inherently doubt the longevity of the military engagement.
They assume it's just a weekend flare-up.
Right, a kinetic negotiating tactic. The market effectively calls the administration's bluff, assuming the disruption will be measured in days, not months.
But then comes step 5 to absolutely shatter that complacency.
Deliberately.
Just when the market thinks it has the playbook figured out, the administration blindsides them. The sources highlight how they suddenly pivoted to using tactical, open-ended verbiage, teasing that wars could be fought forever and touting unlimited weaponry.
You have to pay close attention to the quotation marks around the word forever in the analysis.
It's a tactic.
It's a specific, calibrated negotiation tactic, a dual-purpose signal. To the adversary, it says, "We will not tire before you break." But to the financial markets, it says, "Your assumption of a quick resolution is wrong. Price in a long war."
It's designed to break the market's complacency. And that deliberate destruction drops us right into step 6, which is exactly where we are right now in the timeline of these sources, prolonged conflict pricing.
This is where the blood hits the streets.
Yeah. We were seeing Brent crude surge past $85 a barrel. The Dow Jones plummeted 1,100 points in a single session. This isn't a dip buying opportunity anymore.
It's a structural de-risking. The psychological trick of step 5 worked.
So if we look at the timeline, the first dip gets bought because retail expects a deal. The second dip gets bought because institutions think the action is temporary. But the third dip, this 1,100-point drop, this is when positioning changes structurally.
Portfolios are being completely rewritten. And this exact moment of maximum pessimism is where steps 7 and 8 come into play.
Conditional de-escalation and feedback loops.
For anyone managing long-term capital, this is the most critical framework to grasp. The playbook makes a profound assertion. The current administration is structurally responsive to the domestic stock market and consumer inflation data.
Right.
The severe economic pain generated in step 6 acts as an immovable forced ceiling on the military conflict itself.
Because if we connect this to the bigger picture, you can't divorce geopolitics from domestic politics. The administration's core promises heading into a midterm election cycle are relentlessly focused on low inflation and returning to $2 per gallon gas.
You cannot fight a prolonged war in the Middle East and maintain $2 gas. The math simply does not work.
It fundamentally contradicts the domestic mandate.
The playbook cites specific quantitative estimates. If the Strait of Hormuz is even partially restricted, oil doesn't just go to 90, it spikes to $120 or $130 a barrel almost instantly.
Which is devastating for the U.S. consumer.
Exactly. That energy spike would immediately push U.S. headline CPI inflation back up to 5%, which is a toxic level we haven't seen since the aggressive rate hikes of March 2023.
And the playbook explicitly identifies the pain thresholds, right?
Sustained oil above $90, equity markets dropping more than 5% a week, or national average gas prices jumping 10%.
Once those tripwires are crossed, consumer sentiment collapses. And the central thesis is that the administration is watching those exact tripwires. Once they are approached, the probability of sudden de-escalation headlines skyrockets.
The negative economic feedback loop literally forces a return to the negotiating table, regardless of the military situation. The market pain becomes the peace broker.
Which leads to steps 9 and 10.
Step 9 is the deal and narrative framing. Unless the adversary's government completely collapses internally, a negotiated outcome is eventually reached.
And it's immediately framed as a massive strategic victory.
Always. Definitive proof to the domestic base that the maximum pressure doctrine works. We've seen it with the China trade tariffs, the EU negotiations.
And the Intel confrontation back in 2025. And then step 10 is the ultimate payoff for the investor who held their nerve. The violent repricing.
Yes, violent is the correct word. When that step 9 deal is announced, the market doesn't just slowly recover. It violently reprices upward in a matter of hours.
Why so fast?
Look at the positioning during step 6. Investors were terrified. They dumped high beta tech stocks, hoarded cash, bought gold. They fully priced in the worst-case scenario. The market is coiled like a spring of negative sentiment.
So when the uncertainty collapses via a peace deal, all those defensive short positions have to unwind instantly.
A massive short squeeze driven by geopolitical release. The smart money understands this mechanical sequence. They do not panic during step 6. They wait for retail sentiment to totally collapse.
Which is exactly what's happening right now with the Dow shedding 1,100 points.
That moment of peak retail despair is when the smart money begins buying heavily into the depressed assets.
It's a breathtaking masterclass in market psychology. The panic isn't an accident. It's the mechanism that forces the negotiation. Now, let's take that macro lens and zoom in fiercely on a specific geography feeling the absolute brunt of this panic.
India.
Yes. Let's look at the fallout in the Indian markets because the numbers from Business Standard are staggering.
When you map that theoretical playbook onto an emerging market that relies heavily on imported oil, it becomes a very bloody reality on the trading floor.
To call it sobering feels like an understatement. The benchmark Sensex sank 1.4% to close at 79,116.2. The broader Nifty 50 dropped 1.5%. We are talking about 21.5 trillion rupees with a TN market capitalization wiped out in just 3 consecutive trading sessions.
It's a brutal repricing. But if you look past the headline indices and examine the internal plumbing of that sell-off, it's incredibly revealing about the maturity of the Indian capital markets.
We saw a fascinating battle play out between foreign and domestic capital.
Foreign portfolio investors, the FPIs, reacted exactly as the playbook predicted. They hit the panic button. They indiscriminately sold off 8,753 crore rupees in Indian equities in a single session.
But the domestic side didn't fold.
No, domestic institutional investors, the DIIs, stepped in and aggressively purchased 12,068 crore rupees worth of equities.
They effectively built a firewall.
Exactly. Without that domestic buying, the FPI dumping would have triggered a systemic slide. It highlights a massive structural shift. India's market is no longer entirely at the mercy of foreign capital flight.
But while the equity firewall held, the currency market is a completely different story. The Indian rupee is under absolute siege. It fell to a record low of 92.3 a week against the US dollar.
If we connect this to the bigger picture, a rapidly depreciating rupee is a massive nightmare for India. They import the vast majority of their crude oil. Oil is priced in dollars.
So when oil prices spike and foreign capital flees, weakening the rupee, India suffers a brutal double blow.
They are importing inflation directly into their domestic economy. Every good that moves via diesel truck suddenly costs more.
Which means the Reserve Bank of India couldn't just sit back. The sources detail how the RBI aggressively stepped into the forex markets, dumping dollar reserves to pull the rupee back slightly to 92.15.
They were desperately defending that 92 mark. And that forex stress bled instantaneously into the domestic debt markets. The 10-year government bond yield spiked sharply to 6.73%.
And the RBI had to fight a two-front war, intervening in the secondary bond market to manually push the yield back down to 6.68%.
We are watching the central bank actively deploy its balance sheet to prevent a total macroeconomic unspooling.
Now, amidst all this central bank maneuvering, there was a detail regarding retail behavior that fascinated me. It's what the playbook refers to as the flight to safety paradox.
Ah, the metals divergence.
Yeah. Conventional wisdom is that during panic, investors buy precious metals. And sure enough, gold spiked to $5,149.3 an ounce. But silver fell 20% in 24 hours, down to $83.7 an ounce.
It seems contradictory.
How does that make mechanical sense? They're both precious metals.
It's actually a classic indicator of severe systemic market distress. It signals a desperate rush for absolute liquidity. Gold acts as the pristine safe haven. Institutional capital buys it for wealth preservation.
Right.
But silver has a split personality. It's a precious metal, but is also widely used in industrial applications like solar panels and electronics. So its price is tied to global economic growth forecasts.
When a war threatens a recession, the industrial demand forecast collapses.
Exactly. But a 20% drop in 24 hours is driven by margin calls. When leveraged retail investors and aggressive hedge funds face sudden losses in their equity portfolios, their brokers issue margin calls demanding immediate cash.
They have to dump liquid assets immediately.
Right. Silver is highly liquid but volatile, so they liquidate their silver en masse. The institutional playbook points to this divergence as a definitive signal that the market is in a full-blown dash for cash.
The priority is simply surviving the clearinghouse requirements. That makes perfect sense. Now, let's look at how this macro panic creates real-world ripple effects across the Indian economy.
It hurts physical businesses.
Look at aviation. Indigo reported incredibly strong Q3 operational metrics and 87.7% passenger load factor. Their planes were packed.
But because of this oil shock, aviation turbine fuel ATF was just hiked by a massive 6% overnight to 96.6 rupees per liter.
An overnight 6% increase in your primary input cost completely eviscerates your margins.
It's an uncontrollable exogenous shock. And look at agriculture. India is a massive supplier of basmati rice, and 75% of those exports go directly to the Middle East.
And because the shipping routes are paralyzed, those exports are blocked.
So local prices for premium basmati in Indian wholesale markets are actually crashing. Exporters are forced to dump export-grade rice into the domestic market, causing a massive supply glut.
Which hurts the domestic farmers. And perhaps the most relatable anecdote in our sources today is about the wedding economy.
The destination weddings.
Yeah. Destination weddings in the Gulf are a $9.5 billion sector, and our sources detail couples from places like UP and Ludhiana who are completely stranded in Dubai right now.
Their Burj Khalifa photo shoots turned into a geopolitical nightmare. Flights canceled, airspace restricted.
It perfectly illustrates how a military decision in Washington paralyzes a hospitality industry and ruins everyday lives.
The butterfly effect of globalized supply chains.
Which brings us directly to the core vulnerability. Let's examine the energy squeeze and the resulting domestic sugar rush.
the Strait of Hormuz.
Suddenly the most important waterway on the planet.
It handles 27% of global oil trade and 20% of global LNG trade. If that strait is closed or restricted, the structural threat to the global economy is catastrophic.
And we are already seeing tangible casualties. Qatar, a massive LNG exporter, was officially forced to declare force majeure following an Iranian drone strike near their terminals.
As they legally wash their hands of delivery obligations.
And the impact on India was instantaneous. That single halt disrupted up to 40% of the natural gas supplies bound for Indian industries. 40% vanished overnight.
Gujarat Gas already restricted industrial supply. Shares of city gas distribution companies are taking an absolute beating. They're squeezed by skyrocketing spot market costs and sheer physical unavailability.
Okay, here's where it gets really interesting.
Wow.
In the exact middle of all this energy panic, with gas supplies cut off and industrial stocks tanking, Indian sugar stocks are absolutely rallying.
It seems absurd.
Companies like Bajaj Hindustan are up over 10% in a single session. Why are investors throwing money at sugar processors during a Middle Eastern oil crisis?
It all comes down to ethanol.
Ethanol.
A renewable biofuel produced in India from sugarcane byproducts. It's blended directly into retail petrol to reduce reliance on imported crude oil. As crude prices touch new highs, the imperative to blend more domestic ethanol becomes utterly urgent.
So they aren't betting on people eating more candy. They're betting on government energy policy.
Precisely. There are massive hopes the government will revise procurement prices for ethanol and aggressively raise the mandatory blending target from 20% up to 27%.
What does a jump to 27% mean for a sugar company?
It's transformative. The volumetric demand skyrockets overnight. It transforms them from cyclical agricultural processors into vital domestic energy providers.
They act as a direct hedge against rising crude oil prices.
Exactly.
It's a textbook example of capital flowing to find a profitable solution to a macro problem. While the energy squeeze is a massive challenge, our sources also reveal an incredibly optimistic counter-narrative.
The India growth story.
Let's talk about manufacturing, real estate, and tech. Because the structural evolution of the Indian economy is quietly hitting some historic milestones.
Apple's manufacturing footprint is the clearest signal.
This statistic genuinely blew my mind. Apple has effectively become the second largest listed manufacturing company in India by revenue.
An American consumer tech company dominating the Indian manufacturing landscape.
Through Foxconn and Tata Electronics, Apple achieved over 3 trillion rupees in manufacturing revenue for calendar year 2025.
The only listed company ahead of them is Tata Motors passenger vehicles at roughly 3.49 trillion. Apple is generating more revenue on Indian soil than titans like Tata Steel or JSW Steel.
And it's an export powerhouse. They exported $23 billion worth of iPhones from India in 2025 alone. That pushed India's total smartphone exports to $30 billion, making smartphones the country's single largest export commodity.
It's the undeniable execution of a global supply chain realignment. The China Plus One strategy isn't a buzzword anymore. Apple proving you can manufacture at that scale in India fundamentally changes the risk calculus for every global hardware company.
And we're seeing that confidence spill over into semiconductors.
Yes. Micron's massive $2.75 billion ATMP semiconductor plant in Sanand, Gujarat, is officially beginning commercial production.
No, ATMP is assembly, test, marking, and packaging, not a full fabrication plant. Does that matter?
Immensely. It's the critical final step in the supply chain. Establishing this facility moves India's semiconductor ambitions from political rhetoric to commercial reality. It builds the engineering talent pool and proves the ecosystem works.
And domestic giants are investing too. MRF is setting up a 5,300 crore rupee greenfield tire manufacturing facility in Sivaganga, Tamil Nadu.
All this heady manufacturing requires modern physical infrastructure, which brings us to the structural shift in Indian real estate.
Right. We're moving away from the old model of one-off asset bets. We are seeing the rise of platform-style partnerships.
Global institutional investors like Japan's Mitsui Fudosan and Canada's CPPIB are forming strategic, platform-level alliances with domestic developers like Mahindra Lifespace and RMZ Corp.
What does a platform offer that a direct purchase doesn't?
Scalability and risk mitigation. The foreign capital brings massive funding and global expertise. The domestic partner provides local execution strength acquiring land, navigating approvals.
They're targeting grade A office spaces and massive logistics warehousing.
Building stabilized portfolios that can eventually be exited through public REITs. It signifies a massive formalization of Indian property.
So we have the hardware supply chain maturing, real estate formalizing, but we absolutely cannot ignore artificial intelligence. Over $3 trillion is expected to be poured into AI globally in 2026.
With an unbelievable $810 billion strictly for hyperscalers building data centers.
But for India specifically, there has been this pervasive terror that this AI boom would devastate the country's BPO sector. The assumption was Gen AI would automate away millions of call center jobs.
But the hard data is telling a completely different story.
The paradox that defies gravity, the CFO of Cognizant stated their BPO segment is actually growing faster and delivering better profit margins.
It seems impossible. If AI does the work faster, shouldn't their billable hours shrink?
Right.
But the top-tier BPOs became massive early adopters of Gen AI. They didn't let clients replace them. They replaced their own legacy processes.
They automated the low-value tasks internally.
Slashed operational costs, and then used those saved resources to sell higher-value AI-augmented analytical services. Instead of answering complaints, they sell predictive behavioral models.
They ride the wave and charge clients for the surfboard. Brilliant. Now let's move into our final analytical segment. Our rapid-fire stack of regulatory changes and global corporate moves.
Starting with domestic policy. The RBI has actively tightened regulatory norms for bank finance to capital market intermediaries, or CMIs.
They enacted a strict ban on banks providing loans specifically meant for proprietary trading by these brokers. Why so aggressive?
It's risk management. The RBI sees the geopolitical volatility and wants to ensure no unsecured funding flows from the banking system to brokers speculating with their own capital. They're tightening domestic liquidity to prevent a localized crisis from hitting a private bank's balance sheet.
Speaking of tight liquidity, SIDBI, the Small Industries Development Bank of India, abruptly scrapped an 8,000 crore rupee bond sale.
A direct reflection of geopolitical anxiety. Investors demanded significantly higher yields than SIDBI was willing to pay.
A Mexican standoff in the debt markets. Meanwhile, SEBI is reviewing the classification of agri-commodities and considering lifting a prolonged derivatives trading ban on 7 commodities, including wheat, chana, and mustard seeds.
That ban was enacted to curb food inflation speculation. Lifting it restores a vital risk-hedging mechanism for farmers and processors. It brings liquidity back to the exchanges.
We also have a massive green hydrogen agenda update. India is targeting 5 million tons of production capacity by 2030.
But the rapid expansion of renewable energy required for this is causing severe grid instability in states like Rajasthan and Gujarat. Legacy infrastructure is struggling with the intermittent nature of solar and wind.
And there's a fascinating state-level policy shift in Maharashtra. They're allowing private capital to revive sick cooperative sugar factories using BOT and BOOT model.
Build-operate transfer. Private developers set up advanced processing facilities for sugarcane byproducts on the factory grounds at their own cost.
To make high-value green energy, right?
Cogeneration power plants, advanced ethanol units, compressed biogas, and sustainable aviation fuel. They operated for up to 15 years, then transfer ownership back to the cooperative. It's a brilliant public-private framework.
Let's pan out to the global headlines. U.S. Treasury Secretary Scott Bessent announced Trump's temporary global import tariff is likely increasing from 10% to 15% later this week.
Maintaining economic pressure on the global trading system. A sudden 50% increase in the baseline tariff will cause severe friction in global supply chains and is fundamentally inflationary.
In streaming, a major shakeup is looming. A potential merger between Paramount and Warner.
The streaming wars are entering brutal consolidation. Mid-tier platforms are bleeding cash. A combined Paramount-Warner entity would command 200 million global subscribers to battle Netflix. It's born out of absolute financial necessity.
Apple is also making an aggressive move, launching a budget-friendly $599 MacBook Neo.
A calculated assault on the lower end of the PC market, sacrificing margin for massive volume among students and enterprise fleets to pull them into the highly sticky Apple ecosystem.
And amidst all this, U.S. private payrolls jumped by a robust 63,000 in February.
That persistent U.S. economic resilience emboldens the administration to continue their aggressive geopolitical tactics.
Okay, we've covered a dizzying amount of ground. Let's distill this down for you, the listener. The top 10 actionable developments from these sources for a long-term allocator of capital. Number 1.
The geopolitical playbook is real. Smart money doesn't buy the initial dip. They wait patiently for the third dip when retail sentiment has totally collapsed and duration risk is priced in.
Number 2. Energy supply chain vulnerability. The real-world threat to the Strait of Hormuz makes domestic energy independence, green hydrogen, biofuels a paramount long-term play.
Number 3, the ethanol hedge. Domestic sugar stocks are acting as a direct hedge against rising crude oil prices due to mandatory blending requirements.
Number 4, Apple's supply chain shift. With over 3 trillion rupees in revenue and $23 billion in exports, India is successfully cementing itself as a Tier 1 global manufacturing hub.
Number 5, the semiconductor anchor. Micron's new ATMP plant signals the advanced hardware supply chain in India is moving to tangible commercial reality.
Number 6, Gen AI's unexpected beneficiaries. Traditional BPOs like Cognizant are expanding margins by aggressively integrating AI, disproving the AI job apocalypse thesis for the sector.
Number 8, real estate maturation. The shift toward platform-level foreign investment signals a massive formalization of the Indian commercial property market.
Number 8, currency depreciation realities. The RBI's defense of the 92 rupee level shows shifting macro bounds. Export-heavy sectors will likely find a silver lining in expanded profit margins.
Number 9, regulatory tightening. The RBI's ban on unsecured funding for brokers' proprietary trading is a clear indicator of tightening domestic market liquidity to prevent systemic shocks.
And number 10, the streaming consolidation. The potential Paramount-Warner merger hints at a coming era of massive M&A activity in mid-tier tech and entertainment.
Those 10 points represent the fundamental shifts happening beneath the panicked headlines.
I think we've mapped out exactly where those signals are. Thank you to you, our listener, for sticking with us on this incredibly dense deep dive. But before we sign off, we want to leave you with one final, slightly unsettling thought.
We've talked extensively about how market algorithms and human panic react predictably to geopolitical chess moves. It assumes the adversary and the market are human. But as highly advanced AI systems increasingly manage global institutional capital, absorbing these playbooks into their models, will the playbook still work when the machines are expecting every move?
Wow.
Are we heading toward a future where geopolitical shocks cause absolutely no market ripples at all, simply because the algorithms have priced in the peace deal before the first shot is even fired?